So we are here to give you the a market outlook and strategy for 2025. And this is quite important, more so as we are having quite turbulent markets from the last 2 to 3 months. So now we'll straightway go into, you can say, details, although I think a few of you might have joined later now. We have covered it earlier. First being that the Nifty is in a downgrade cycle since first quarter FY25. Since October 2022, it was in an upgrade cycle, but now we have seen EPS cuts happening in the last 2 quarters of around, say, till now, the cut has been around 7 and 6% approximately for FY25 and 26. The markets have been volatile and partly, I would say, adjusting to the current situation of high inflation, decline in government capex, tepid consumer demand, and a fear that the growth rates might suffer given the fact that every state government where the election is happening, so everyone is these days distributing free money, freebies or bounties to people, which is not leaving much money on the table for capex and some of the other infrastructure projects. Then we have seen a situation where the US bond yields have gone up because the interest rate cuts are likely to be on the lower side over there. And the gap between the Indian GSEC and US, which was 270 bips in July 24, and in January it went down to 215, and currently it is around 230 bips. Food inflation currently slightly less than 9. It went up and peaked at around, say, 10.9% in October. The government has been trying to accelerate capex, and there has been some uptick in the ordering momentum in railways, defense, power, and data centers, etc. Going forward for the markets, US policies under Trump 2.0 and Indian budget, they are the two most critical factors. Up to the month of November, for which the official data is available, the capex was on the lower side. The taxation growth or the taxation collection was good. So overall, I would say the government will be able to meet the fiscal targets this year, but the capex will be on the lower side. Next year, the budget is likely to provide some push for the capex, the details about which we will share in the coming slides. So we remain positive on the India capex story, healthcare, tourism, discretionary consumption, and financialization of savings. We recently have cut our Nifty target by anywhere between, say, 0.5% to 1.5% to 2%. And I believe that as we go along in the earnings seasons this year, so we will see earnings cut coming in large number of companies, more so for FY25 and 26. Now, this is the overall context in 2024 and how we are looking at some of these factors in 2025. In 2024, we had post El Nino very intense heat in the beginning, and then very, I would say, very fierce monsoons and prolonged also. So while due to the summer heat, there was some impact on demand for most of the products and the people suffered. The intense monsoons also resulted in damage to crops and significant increase in the food grain and the food products prices towards the September and October months. So now this inflation was also accentuated by increasing the edible oils duty by Government of India by 20%, some relaxation in the export of onions, as well as some change in the norms with regards to the export of rice from India. So part of it was, I would say, due to the natural weather-related conditions and partly because of the policy decisions. For that, there was last year the capex, which has been driving the Indian economy from the past 3-4 years, particularly post-COVID. So that has also been on the lower side because due to the election code of conduct, the new ordering as well as expenses undertaken, they were on the lower side, and they started picking up only, I would say, post September or October of the current year. So the capex has also been on the lower side, and in first half, actually, it fell by 12.7% on a YY basis. FI flows have been volatile, and in FY 25 so far, they have been around $2.5 billion on the negative side. Geopolitics like Russia-Ukraine war, Middle East unrest, Israel-Hamas war, all they have got a negative impact, both in terms of volatility of oil prices, as well as disruption of the supply chain in the world, due to which the freight rates as well as the material cost in a few commodities or components has been on the higher side. Now, as we look into 2025, we had good monsoons. Your crops are likely to be good. Ordering by the government for capex has picked up across railways, power, defense, roads, ports, etc. Inflation has started easing. Food inflation is already 8.9. CPI is also likely to come to something like 4.5% over the next 3 to 4 months. So that should provide some elbow room to RBI also while they are looking at the interest rate cut. The FI flows till now, they have been volatile, negative, and they might turn positive, but I will take you into the details because in the past few years, they have always been very volatile. In terms of geopolitics, now the new US government is there. Mr. Trump has resumed the office. There is already an end to the Israel-Hamas war. Russia-Ukraine war might end, I don't know when, 3 months, 6 months, but there is some ray of hope that that war might also end. But there could be some other conflict which can erupt, maybe with Iran, maybe with, you can say, your Syria, or maybe you can say some of the other countries. So such like conflicts can't be ruled out. Now, as I said about the monsoons, currently the water reservoirs are comfortable. Till the end of December, the Rabi sowing has been good. And as the table shows below, that last year monsoon has been very volatile, sometimes -20, sometimes +20. So that has actually had a very negative impact on the crops and the overall agricultural production. Now, as I said, inflation, food inflation surged because of, you can say, some crop damage, some of the measures which was taken by the government to provide some relief to the farming community and some industries. So that has already peaked out, and currently it is at 8.9. And I think as we go along, it is likely to be, you can say, trending lower only. The interest rate cuts from the past, if you look at repo rates, you can approximately, it's more than, say, year and a half, there has been no repo rate cut in India. So if the budget goes down well, if the new budget gives the right direction, so we are expecting a small rate cut to happen towards February, and maybe another 50 bips can't be ruled out as we go along in 2025 calendar. Now, rupee traditionally 2 to 3% has been the depreciation rate, although India has actually done better than most of the other emerging market currencies. FI flows, as I said, they have been volatile. After 2Q, the FI flows again went into a tailspin. They improved after the, you can say, a new government was installed in India. And after 2Q, as the inflation increased, as the demand conditions became uncertain and tepid, the FI flows again went into the negative territory. So going by the track record, particularly of the last 4 or 5 years, for example, FY 22, 23, they were on the negative side. So FI flows will remain volatile. Once they come, they might come, say, maybe $10, $15, $20 in 2-3 months, and then they can again be on the negative side. So FI flows are likely to remain volatile. The geopolitical conditions, as I said, they seem to be, you can say, looking for better. But having said that, I don't rule out that in certain areas the conflicts might be less, In certain areas, the conflicts might increase, but overall trend, I would say, is likely to be on the positive side unless and until some big incremental war starts. Now I will take you through the urban demand, because what has happened is that, as I explained earlier, that election plus intense heat, then excessive rains, and very weak marriage season. Because in India, weddings, festivals, they generate a lot of spending and lot of demand. Now, what happened in this year in particular, which is very abnormal, that after, say, 15th of May till the beginning of November, there were no marriages, whether it was North India, whether it was South India, because usually South India has got a summer wedding calendar also, but there also after May, the marriages were very, very few, except I think in perhaps Tamil Nadu for say 10, 15 days. So the entire wedding season got pushed to 3Q and 4Q. And due to that, it was also one of the factors which actually impacted the demand. But coming to the more on the, I would say, macro side, there is one clear factor which is at play. First of all, that real wage growth in the urban sectors has remained subdued, which means that the overall increase in the wage inflation, which is related more to at the lower to lower middle class, that has been less than satisfactory. Now, another peculiar thing which has been happening around is that you can say, if you look at the overall demand, whether it is auto, whether it is consumer, whether it is discretionary, the premium goods or the premium segments have done far better. For example, you look at cars, or which you call as passenger vehicles. The SUVs and premium vehicles have done well, whereas entry-level vehicles are not doing. There is some upgradation, but there is definitely some pressure on demand at the bottom end of the pyramid. Now, in certain areas, interest rates are also very critical, and high food inflation and elevated interest rates have also eroded the purchasing power of the lower to lower middle sections of the population. Now, credit cards these days are used very extensively for spending, more so in the urban, or even I would say now in the tier 2, tier 3 cities. Now, what has happened that the growth in the total amount spent on the credit cards, as well as the new credit card issuances that have gone down. The new credit cards issued in the past few months, they have been much lower than what has been happening earlier. And this is due to the fears of RBI that there is pressure on the income of consumers, and there could be non-performing assets which can come from the unsecured lending, which is including the credit cards. And that is where the card issuances have gone down. And the banks are today becoming much more selective. And consequently, if you look on the chart which is above, the overall spending growth in credit cards, that is also on the lower side. And while we are, you can say, calculating that, we have actually taken a 3-month bracket, which is coinciding with the festival season, that this festival season over last same September, October, November, these 3 months, the spending this year is up by only 13%, whereas last year it was up by 31%, which clearly shows that the demand is under some sort of a pressure. Now, having said that, we are of the view that we might have already seen the worst, or in terms of demand, either towards, I would say, either the worst is already there, or to put in other words, I am expecting that maybe towards the second half of Q4, that is beyond say February 15th or end of February, we will see the overall demand to start improving. Because if we look at say, some of the parameters which we looked at, and these are intentionally, we have taken the reported numbers or the estimated numbers of companies. For example, consumer sales. Okay, so 1Q and all, they were high because of the AC sales, but otherwise, if you look in comparison to last year, the numbers are looking better. Okay, you look at passenger vehicles, yes, they have been under pressure. Staple sales, they have more or less bottomed out. Quick service restaurants, their sales growth is showing an accelerating trend. Jewelry, because of the seasonal uptick plus higher gold prices, is in the positive territory. Retail is doing much better, also partly aided by the seasonal uptick. And if you look at the Naukri Jobs Peak Index, the overall employment generation or the availability of jobs in the economy, that is increasing. So based on this, we believe that now all these parameters plus peaked out inflation plus likely cut in interest rates. So I think maximum by, you can say, Feb and March beginning, we should see some uptake in demand to really start happening. And this will also be combined with the likely increase in the capex by the government, the details about which I will share with you just in a couple of minutes. Now, a lot depends this time on the budget, and I think budget this time around is far more important than it was, say, last year or even year before that. Because Indian GDP growth this year is likely to be lower than what we have seen in the past couple of years at least. We used to be 7 to 7.5% range. This year it is likely to be 6.4% range. And next year, I think it would be fair to presume around, say, 6.2 to 6.5% as of now. Now, there is likelihood that government might give some relief to urban middle class or overall middle class and senior citizens to some, you can say, standard deduction or reduced tax rates, etc. Now, as I said, the populist measures during the state elections, such as cash payouts, are adding pressure on state finances, which is impacting the state level capex. And it is clearly visible in states like Karnataka, Punjab, Himachal, Uttarakhand, and Maharashtra has also joined the same list. Because I think 2-3 days back, I think there was a news that they are cutting back on all sorts of capex by 15th of February, till 15th of February. Now, this happens because once you start giving cash dole-outs, first of all, giving this your cash money in form of any scheme, you see, such dole-outs were actually very much prevalent in countries like US and Europe. But that has actually resulted in some of the European countries also going till the stage of bankruptcy. And India, by far, in comparison to them, we have got a large population. India is a relatively, I would say, it's not that rich a country. Plus, we have got a lot of spending which requires to be done on the infrastructure side. So we can't afford to, you can say, pay out money like that. That is one. And the second thing is that when the government announces the capex, lot of projects are where there has to be some contribution from the central government and some contribution from the state government. Now, if the money is distributed to public, then the overall pie of capital which is available for spending in the infrastructure or other public works, whether it is roads, ports, you can say at the state level, maybe a power plant, maybe flyover. So that money goes down, so which has the potential to even further squeeze the overall capex in the economy. Now, direct taxes, they have been doing very well, 23% increase even for the first 8 months. Indirect taxes have suffered because the economy is in some sort of a slowdown mode. Now, if you look at, say, some of these numbers, I will just give you very, I would say, I will not go into the technical numbers over there. I will show you just these 2 slides. Now, the overall income tax collections have gone up. But a lot of it also is to do with the increase in the collections under the short-term and long-term capital gains. Because that amount is 2.5 to 3 times in the last 3 years. And the share of capital gains is up from something like, you can say, if you look at pre-COVID, it was 20% in the overall income tax collections. In FY23, it went to 42, and last year it was 31%. So increase in the capital gains tax collections, which has also been attributed to the buoyancy in the stock markets. That has been one of the factors in boosting the overall revenues of the government. If the markets continue to suffer or they remain volatile for fairly or tepid for fairly long periods of time, then it has the potential to even start impacting the overall tax collections of the government. So in the overall context of things, we are expecting next year GDP growth to be there or slightly higher than where we were last year. Nominal GDP growth to be in double digits. Fiscal deficit, this year target is say 4.9. I don't rule out that number or even a slightly lower number. Now, your capital expenditure, this year till November, it has been on the negative side. I think for the full year, we will not meet the target, but next year, I think government is going to show you 15 to 20% increase in the planned expenditure on this. Similarly, your PSU disinvestments, they have not been happening much. So there could be some sort of a, you can say, push which can happen on that side. Now, before going into say numbers of Nifty, etc., two things here. First of all, we expect some more EPS cuts to happen in the current earning season. That is one. However, if you look at this chart of the earnings, you can clearly see that the earnings, for example, the charts which are of previous 23, 24, 25, the charts were gradually moving up. But now from the last 2-3 quarters, there has been trending down. But I think it might last, say, at least in 3Q, to some extent in 4Q, and after that it should stabilize. However, given the correction which has happened in the markets, and I think if we plot this chart today, then the current P multiple may still be slightly 1 or 2 notches lower than what it was there. So as of now, the estimates are 14% Nifty EPS CAGR over FY24 to 27. I think at least in FY25, the cuts will be there. But beyond FY25, we should be able to give the double-digit kind of an EPS growth for Nifty. And currently now Nifty is trading at 4.2%. I think if I look at current, might be say even higher discount to the long-term average, which is 15 years we have taken. Now this is a model portfolio which we give in our report every time. So we started this 5.5 years back, approximately, slightly more than 5 years. So it has outperformed Nifty by 24% since that. And if you look at the absolute returns, I think it might be 140, 150%. And we usually put stocks only which are under our coverage. And if you look at this portfolio in particular, we are, I would say, quite positive. We remain positive on capital goods, healthcare. These are the two. I would say not much positive on banks and IT. So these are, I would say, these are two pockets. Cement is another. And maybe on the consumption another, it is more like you can say you're very, very stock specific kind of a call and not a big sectoral call. So this, as I said, that for the current quarter, numbers are likely to be on the tepid side. And as we go along, we are expecting that there could be more cut in earnings. And I think the whatever numbers or whatever companies they have released the results so far, I think in large majority of them, there is a miss and the estimates have seen a downgrade. These are, I would say, usual stuff. And these are some of the picks which we have given in our report. These are actually, you can say, some 20 stocks. But out of these, actually, we have figured out, say, some around, say, 10 odd stocks, which we believe in the current context, they are very safe stocks where the fundamentals are strong. The downside is very, I would say, limited. And over the next 12 to 15 months, many of these stocks can easily give you anywhere between, say, 15 to 20, 25% kind of a return. So I will just give you a very, very brief of these names. For example, Bharat Electronics is there, Britannia Industries, Larsen and Toubro, Mahindra and Mahindra, Max Healthcare, Polycab, Reliance, Siemens. All these are large caps. And then on the mid cap side, we are having Aster DM Health, Crompton, Cyient DLM, and Paraj Industries. So Sandeep, you want me to take them into details or give them some, you can say, little bit of flavor on why these stocks are in our, you can say,
It would be nice, Amnish, given the way the markets are,
okay,
if you can give a brief summary,
sure,
it'll be okay, a bird's eye
okay,
view.
okay. You see, the first stock which we have written, Bharat Electronics. So why I like this stock over other stocks in the defense space? You see, defense orders have been increasing for everyone. But the advantage which Bharat Electronics has is that this company is not dependent upon any single segment of defense. For example, they cater to army, they cater to your navy, they cater to air force. Around 15 to 20% of your top line also comes from non-defense orders. So they are actually, whether it is, you can say, night vision equipment, whether it is catering to some of the electronics requirements in radars, your tanks, because these days, even if it is a military hardware, without good quality components, electronics, software, nothing will work. And so it makes Bharat Electronics a very comprehensive play. Their order book is nearly 3 times the current sales. They can give you around 15-16% PAT CAGR. And the valuations currently are around 32 times, which I think is quite decent for this company. And Bharat Electronics has been listed on the stock exchanges from the last close to 30 years. So there's a track record of performance. And the stock has also corrected from something like 320-25 plus to currently 270 to 80 range. So I think buying at the current price, given the steady track record, good future, and the current valuations, I think there is very, you will not lose money in this stock. Second one is Britannia, where you see the overall consumption demand and staple companies are not doing well. But Britannia has actually corrected from 6,200 to the current level of less than 5,000. It went actually down to 4,500. But this is one company where you will not see a disruption. For example, you might not have seen new biscuit brands on quick commerce. If you go and buy any imported biscuit brand, whether it is a Biscoff, whether it is, you can say, a biscuit from Kraft or any other global player, the price may be 5 times more. So unlike personal care or some of the other consumer segments, it is not possible that someone launches a 5 rupee pack of a biscuit, any global brand or local brand, easily and get away with it. So the disruption in this industry is not there. The margins are under pressure. This quarter also the profits will decline in, I think, anywhere between 8 to 12%. Next quarter also will be under pressure. The raw material prices are high, but I think after a turmoil of another quarter or so, things will stabilize. And this company will give you 15% CAGR over the next couple of years. The company has got a payout ratio of 80 to 90% in dividend and an ROE and ROC of more than 60%. So my sense is over the next 12 to 15 months, the stock will go back to from where it has come. The third one is your Larsen and Toubro, which I believe is the most diversified play on India capex, with presence across segments like infra, EPC, defense, airport, ports, you name it, and every large, you can say, project in the country, whether it is an Atal Setu or the Mumbai airport or some of the other marquee projects, including our own parliament, new parliament, they are all made by L&T. Now, this makes L&T a very structural play. They are having some issues with 1 or 2 power plants they are operating or Hyderabad Metro, but I think the losses there are also coming down. Now, two interesting things can happen over here. One being that this company, being a diversified play, also has got 2 companies in the IT services sector, that is LTTS and LTI. And they also play in the NBFC sector through L&T Finance. Now, if any potential uptick happens over there, so that also get captured in L&T by virtue of these SOTP valuations. That is one. The second is that US under the new leadership is likely to focus more on exploring oil and gas and less reliance on renewable and some of the other other aspects related to that. And they have already now said that we are out of the Paris Convention Treaty, under which US is actually the most polluting country in the world, and they were actually not digging wells or exploring oil and all. So once their focus on oil and gas comes, there could be a lot of things which can happen, lot of demand for the capex related to oil and gas, which might come from US, it might come from some of the other countries, and L&T has got a big stake in that. So there's a likelihood that the rub-off effect of that directly, indirectly can somehow come to L&T also. And the valuation for L&T, they are not expensive relative to where they used to trade historically, even 10, 20, 25 years back. Then Mahindra and Mahindra, I think the only passenger vehicle company which is still growing in double digits. And over the past 4 or 5 years, the entire portfolio is refreshed. All the new launches have done well, whether it is your XUV 500, whether it is whether it is Thar, all the launches are doing well. They are ramping up the capacity, and they are also benefiting because the normal monsoons are improving the demand for tractors. Now, Mahindra and Mahindra also, like L&T, they are present in IT services through Tech Mahindra. They are also having a finance company, and this is again a conglomerate. So relative to others, the stock has done well over the last 12 months or so, but now it's currently in a correction mode. But I think it offers value at the current price of around say 2,800 rupees. Then one of the other stocks, I think, where we have been very positive from last 2 to 3 years, is Max Healthcare. It's a potentially currently maybe in the top 3 hospital chains in the country. And I think whatever the investments they were making from the last 3 years, I think the benefits of that will now come. Their bed capacity will go up by 80% approximately. And quite a bit of it, whether it is in Nanavati, Select Saket in Delhi or Mohali, that is a brownfield expansion where the path to profitability will be much easier. Even their new acquisitions in Lucknow and Noida, they have done well. And this company should see actually its EBITDA doubling over the next 3 years. So I think this company should provide you 30% kind of an EPS CAGR. And this stock in particular has corrected, I think, by around 10-12% in the last few sessions. And I think around 1,050, the stock looks really interesting. And my sense is that our target is around 1,200, but I think the stock has the potential to go much higher than currently what is being ascribed at. Maybe another year and a half, it could even give you 30-40% return on the current level. And Polycab, another player, again, slightly capex play, because it's a play on both, you can say, your wires, which are used in real estate, to one of the very few players who is in the high tension as well as extra high tension voltage segment of wires. Good company. They are expanding the capacity, market shares are strong. And I think this is another player where you can expect around 20% profit CAGR. So the growth here is intact. A lot of investments are happening in power. So that will also benefit Polycab. Then Reliance Industries, where I think the oil and gas segment and petchem has always been very volatile from quarter to quarter, 1 quarter here, 1 quarter there. But I think the major events here will be, one, the value unlocking in Jio platforms. The second is retail. And the third is if they potentially scale up their new energy business, for which they are taking baby steps one at a time. But I think at the current valuations, because this stock has also corrected by say around 15% odd. So I think Reliance also looks good over the next say 12 to 15 months. Then Siemens, which is among, I would say, the top 10 players, or rather it is among those 8 to 10 companies globally which are having all the right kind of technology, whether it is related to power, energy transition, data center, cyber security, automation, railways, etc. So it's a very formidable play, strong order book, technology leadership in a lot of things. And here this company is going to be split into 2 companies. One is your Siemens Energy and one is Siemens India. So that is also going to unlock value. The stock has corrected now considerably from 8,000 rupees to the current level of around 6,000. I think at the current price, the stock really looks good. I think these four mid caps, one is your Aster DM Health, another hospital stock, where there has been, you can say, consolidation. This company actually, let's say, will be the second largest in terms of the number of beds. Aster DM, after the acquisition of Quality Care, uh, I think there's a scope of margin expansion also, and I think this stock will give very decent returns over the next 2 to 3 years. Then Crompton Greaves Consumer, a company which has not done well over the last couple of years because their one acquisition didn't do well, and there's also some slowdown in demand. But I think incrementally the worst seems to be over, and one can expect from these low levels around at least 20% kind of a PAT CAGR, which could provide decent returns in this stock. And then two, I would say, stocks more. One is Cyient DLM, which is your EMS company. This company caters to, for example, aerospace is there. Then they are also catering to, they have done acquisition on the your medical technology. They have added, you can say, on the lines of semiconductors, medical healthcare. So I would say the entire EMS space is doing well. So this company can potentially grow at 25 to 30% relative to some of the other EMS players, whether it is, you can say, Keynes or Dixon or Sirma. So this company is relatively, you can say, inexpensive, trading at 20 to 23 times. And I think it, in the normal course, it has just to continue growing the way it is growing, and I think the returns will eventually come easily. And finally, Praj Industries, where I think this is one of the very exciting stocks because it's related to ethanol blending, and the stock had not done well over the last year and a half, barring a couple of months back when it again got into limelight because of the restrictions imposed by the government on conversion of you can say sugarcane and molasses into ethanol. But India is targeting to increase the share of blending to 20%. That is one. Secondly, there are a lot of emerging opportunities for this company in sustainable aviation fuel, for which the US and Europe are looking at the blending of 10% and 6%. And for that, US needs to make changes in their existing plants, which will actually be a $300 to $400 million opportunity for the coming 3 to 4 years. Similarly, the compressed biogas, where there is, you can say, huge pipeline to establish biogas plants in India. So that will generate a lot of business for this company. And they have recently, for the engineering business, they have already set up a huge new facility in Bangalore, which will also start contributing. So they have given a vision 2028. So over the next 5 years, this company is looking to increase revenue by, I think, 25-30% kind of a CAGR. And in this company, the beauty is that the stock is not that expensive. And if the entire scenario plays out the way it is seeming to me and the way I look at it, it will not only give you profit growth, but the P multiple, which currently might be running at, say, anywhere 25, 27 times. So those P multiples can actually eventually go up to anywhere between 35 to 40 times, where most of the capital goods companies are trading at. So from the next 3 to 4 year kind of a viewpoint, Praj Industry looks good. Although for the next quarter or so, I think the numbers are not likely to be exciting. So there could be a potential even to get this stock at slightly lower levels, maybe 5-7% lower from where it is trading at. I think that is uh, all from my end. And Sandeep, if there are any questions or if anyone has got any queries, I will be happy to address that.
I think participants, if you have any questions, you may please write in the chat box and we'll take these up. If participants have any questions, please write in the chat box and we'll. Amnish, there's a quick question. I don't know whether you should be answering it, but I'll still mention it. Do you see the Nifty bottoming out in the near term, or are there further triggers?
You see, I don't have actually, I don't comment on where the technical support levels and all are, I would say, placed, because that is not, you see, I can look at that, but that is not the forte for me to, you can say, discuss here. But having said that, uh, if you look, if you ask me what will happen, say 12 months down the line, I'm pretty sure that this year is going to, last year Nifty returns were around 8% in the calendar year. So my sense is this year we should be able to generate double-digit returns comfortably. So everything depends upon three events. One is what Mr. Trump does, second is budget, and third is interest rates. Because I think weather this year is not likely to pay much trouble, because both El Nino and La Nina they are over last year. I think if these three events play out well, I think the returns should be good in the current year.
Any view relatively or absolute terms on small and mid caps, valuation wise?
You see, Sandeep, what has happened that if you look at the entire small cap, mid cap space, maybe 3-4 months back, many of these small caps or mid caps, their valuations, they were much ahead of the large caps. And the logic given was that these companies, they are growing faster, so there is no harm in giving higher multiples to them. You see, there is a case, say, for example, if you look at some of the very large companies, whether it is, you can say, Lever or whether it is ITC, can they grow at 20%? The answer is no. They can't grow at 20%. Even Asian Paints cannot grow at 20%. But now, if these companies are trading at, say, 40 times, does it mean that for much smaller companies, just because they can grow faster and they don't have much business model cash flow, we should start paying them 60 to 70 times? So I think at this juncture, it is not that the mid caps or small caps are untouchables, but this year one should adopt very, very stock specific approach. So it is not that only mid caps will do well or only large caps will do well, but relative to how markets behave at the current juncture, I think the risk reward, or to put it other way, even the large caps today, they are offering the scope to make pretty decent returns where the risk levels are also on the low side.
All right. And a very quick view on Asian Paints, CAMS, and Zomato.
Okay. You see, Asian Paints, we have been negative from quite some time. Even when the stock went to 3,400, I think some 4-5 months back, we remained negative on the stock, and I think there is no case to change our view even now, because the industry is changing. There is no scope for the company to increase the margins. Now one big large player, by spending 10,000 crore, has already come into the market, and this industry has not seen any big player coming into the market the way Birla Opus has come in. There is a likelihood of another MNC, Akzo Nobel, exiting. God knows who will buy. Maybe a Berger or a JSW or even Pidilite might be in the fray. So if any large, strong company buys Akzo, which has been a laggard in the Indian market despite being a global leader, the competition will further intensify. So while in hindsight, one might say that Asian Paints has corrected a lot. However, given the fact that the earnings growth visibility is poor, I would still tend to avoid Asian Paints, at least in the near to medium term. Or for that matter, I will not touch any paint stock at the current juncture. And that has been what our recommendation has been for quite some time.
CAMS, Zomato, any PSU banks or the sector as a whole?
Okay. You see, when it comes to Zomato, I think this quarter has just shown the glimpse of what is going to happen over the next maybe 6 to 12 months. because Zomato is going to accelerate the dark store openings. They earlier were looking at 2,000 dark stores by December 26. Now they are looking to do that by December 25. So obviously your infrastructure costs, the overheads, they are going to increase faster than what it was anticipated. That is one part of it. The second part of it is that all your competitors, earlier there used to be 2 to 3 players, now there are 6 to 7 players in quick commerce. And many of these players, whether it is Swiggy, whether it is Zepto, so now they are well capitalized. So giving, you can say, yeah, cash in the wallets to buy stuff that is going on from the last month or two, which is not good for the overall state of the industry. While quick commerce might gain share from other segments, but the profitability growth might take a backseat for the next 2 to 3 quarters. So in the longer term, Zomato seems to be better placed because it has got 19,000 crores of cash in its books. However, the cash generation has gone down. So in the near term might remain under pressure, but it should be among the winners in the medium to long term. So at the lower levels, one can look at Zomato. But having said that, it will also depend upon how the overall sentiment behaves, because this is one stock which had also gone up from something like 50 rupees to 300. So in the near term, it can correct slightly more also. That can't be ruled out. But in the long term, it is likely to be among the winners in the quick commerce space. On banks, I would say, first of all, if you look at, say, 3 years back or 4 years, or rather pre-COVID, HDFC Bank used to be traded at 4 times price to book. IndusInd used to be trading at, I think, 3.5 times. Even Kotak was above 4. Now, the banking sector as such is changing. Their balance sheets are better. But can they grow at 20% CAGR or 25%? The answer is no. Can the price to book of all the banks, will they revert to 3.5 times, 4 times? I think that is not going to happen. Today, you look at ICICI Bank, which is today the best performing bank. That is, the targets are 3 times. The stock is, I think, trading at maybe 2.4 times. So today, for any bank to get more than 2.5, 3 times is going to be very, very difficult task. And today, only one ICICI Bank is there, which is trading at 2.4 times. I think rest of the entire pack is less than 2 times. So I think this is a structural change which has happened. I don't rule out 5 years down the line. And I think it has also played out in, say, Bajaj Finance. People used to value at 9 times, 10 times. Now it is at 4 times. So if you are buying any of these NBFCs, finance stocks at 8 times, 7 times, 6 times, the money is not going to be on the table. It's structurally 5 years down the line, will banks be trading at even 2.5 times, 3 times? Right out. Because globally that is not the case. So maybe 5 years down the line, you should ascribe a value which today you are, say, giving 3 times to some particular bank. So it may be, say, 2 to 2.5 times. So many of the banks will give you money, but to expect banks to give you very high returns of being a multi-bagger or doubler in 2 years or something of that sort, so that is something which our expectation should not be from the banks in general. And when it comes to PSU banks, relatively much cheaper than private banks. Most of them would be trading anywhere between 0.8 times to 1.2, 1.3 times. The technology stacks are today much better. The balance sheets are looking in far, far better shape. And I think I would say, at levels, I think PSU banks can also give you reasonable returns. But in any of these stocks, one should not expect any bountiful returns to happen that someone will, as I said, doubler in 2 years or something like that. So that should not be the expectations with any of the banking stocks.
Thanks, Amnish. Thank you everyone for participating in this call today. There are a few more questions, but I would request everybody to please write these in to advisorydesk@plindia.com and we'll surely revert on these. Amnish, we've overshot our time. So thank you so much for hosting this call for us and giving us clarity, and look forward to your next market update after the budget. Thank you so much.
Thank you.
Everyone. Good evening.